bit about Altair, then I will. So Altair is part of a group of companies which we call Aquila. And Aquila is a sort of consultancy group that I think our mission is to make a difference to people's life, both in the UK and globally. The mission of the group is to create a better, sustainable, and socially responsible world. And we are lucky that we're quoted on the London Stock Exchange, although that brings us challenges. Well, the group as a whole, as you can see from the slide, consists of 4 main organizations. Altair, which I'll talk to you a little bit about. Oaks, which is one of our subsidiaries that provides strategic planning, fundraising, and income generation services for sports and education groups. So we do work for Premier League community foundations, for FIFA and various foundations, and also for charities as well. And then the third element of the group is ATFS, which are independent treasury advisors. We provide advice on debt, ESG financing and reporting, accessing capital markets, interest rate risk management, and so on and so forth. And then finally, you've got Asset Core, which is a collaborative sort of technology platform system we've created to provide a single source of data for asset-related transactions in the housing sector. So it helps clients to obtain visibility of various legal and financial interest in their asset portfolio. So that's a sort of a nutshell about Aquila, which hosts a lot of subsidiary advisory organizations. Next slide, please, Jen. And specifically Altair, which is probably the face of the organization that most people will know. Our focus is, we pride ourselves in the sense that we are probably one of the world's leading organizations that's focused specifically on housing, on the housing value chain. And the breadth of services include housing market analysis. We help design interventions, we do research, implementation of those interventions and capacity building, housing finance, business planning and financial modeling, and as well as sustainability, as well as the green agenda that Kessia was talking about. And one of the key things that when we're trying to plug or sell ourselves is that most of us are actually practitioners first, before becoming consultants second. So a lot of us will have either the managers or chief executives or operators of housing institutions. So enough of about Altair. If you move on to the next slide, please. Yeah. So why we're here, which is the objective of this webinar series that Kessia has kindly introduced. The purpose of the series is in conjunction with the African Union for Housing Finance, AUHF, is to share our experience of supporting clients over the years to set up various types of rent-to-own schemes globally, to sort of discuss some of the financial and legal structures to assist in creating the sort of institutions that will that could be scaled up and to ensure long-term viability of some of these rent-to-own institutions. And in addition, as I mentioned, the presenters have held responsibility for managing significant portfolio of rent-to-own type projects to some extent on a large scale of about up to 100,000 homes. What this series will cover is actually, one, we're trying to reaffirm the importance of rent-to-own as a tenure to be given due attention in light of the well-known slow rate of mortgage take-up in Africa. We will want to explore the strengths and weaknesses of rent-to-own as a tenure, help sort of articulate the operating conditions we believe are required to successfully implement rent-to-own, as well as engage in a panel discussions with key players in Africa on the challenges and opportunities of implementing rent to own. Importantly, I think the theme of what we're trying to, hopefully at the end of the series, to come up with is clearly the pathway or potential blueprint to scale up rent to own from an institutional point of view. We do know it exists in one form or the other, informally. We do know there's some players, but in our view, there's huge potential for it to be scaled up. And if nothing else, we hope that the series will stimulate debate about rent to own as a legitimate tenure and the opportunity it offers to address the housing deficit in Africa. Next slide, please. So without boring you with the statistics and data that you all know very well, and also the key messages that has been coming from AUHF and CAF and over the years, the data has been well articulated as far as I'm concerned. But the worrying situation is that as of today, that deficit that people have consistently talked about, the backlog, has not been in any material way been addressed. And there's an argument that actually the deficit is increasing either because of rapid rate of urbanization, the lack of new supply of any material means, limited housing finance options, and then when you add on the increasing challenges of implementation of climate change, in terms of how you address existing and new buildings, you can imagine that actually, I think it's reasonable to use the term or the word crisis. And quite clearly, in my view, that crisis must be addressed urgently. So we see the potential for rent to own in terms of large-scale implementation of it as one of those possible solutions to address some of the challenges that Africa faces in terms of addressing the provision of new housing supply. And what we're going to do is to explain how we believe rent to own, if it's implemented properly, could be a potential solution to sort of increase the volume of new supply. Next slide, please. So this particular session today will cover basic principles around it, because you won't be surprised that there's so many versions of rent to own across the world. But what we'll try to do is to give you sort of what we call the common themes of it, because there's huge variations of that. We'll give you an overview of the types of rent to own, knowing that we'll go into more detail about particular types in our in the sessions to come, and in some cases also we will feed into it some of the African contextual issues as its impact upon the attempt to implement rent to own as of in terms of current positions. What also we'll try to do is that we will want to start exploring how sort of rent to own can be scaled up and institutionalized, and Derek will cover a number of those from a sort of financial perspective. But importantly, I think what we hope will come out of this series is, as I said earlier, is an opportunity as a tenure it offers in addition to mortgage products. Next slide, please. From our perspective and from our experience, there's significant benefit to rent to own, especially when it's implemented on an institutional basis. It has the potential to provide offtake solutions, which will stimulate supply of new homes. So what do I mean by that? If rent to own is being built for specifically on an institutional basis, then it could address some of the challenges we face at the moment, whereby developers complain, or not complain, but actually do flag the problem and concern that the inability to provide supply on a volume basis is because there's no means of purchasing them. And we see that if it can create a corporate environment where institutions are purchasing new developments, it will act as a catalyst to attract new supply. It offers choice, as far as we're concerned, a way or alternative to the requirement for mortgage, housing mortgage. Even though we do believe a number of rent-to-own options also depends on ability to, it's a route for people to purchase their homes in terms of mortgages, but nonetheless, there could be types of rent-to-homes that makes use of the current practice in a lot of places in Africa, whereby people are actually paying in a form of installments. And I think there are ways in which we believe that could be designed and that current practice could be extended as an opportunity in lieu of mortgages for people to own their homes. One of the benefits of rent-to-own is also that it does provide long-term investors like pension institutions with alternative investable products that can match assets with liabilities. And that's one area that I think it has huge potential in Africa, where currently pension institutions bulk of the time are investing in government securities. We do believe that actually if rent-to-own can be designed to make it attractive for pension institutions and long-term investors, is actually one way you can institutionalize rent-to-own as a product that is attractive to pension institutions. We also believe that it's an opportunity for pension institutions to effectively demonstrate compliance with ESG or SDG regulations. I think increasingly a lot of pension institutions at the moment, in their guidance note or compliance note, are required to implement or comply with ESG. And we feel that if rent-to-own could be a product that could be, if it's added to their portfolio, as we've seen in Europe and US, it could then help address that particular area. Next slide, please. Of course, rent-to-own has challenges, and especially in the context of Africa, the challenges of attracting long-term investors to play a role. There are also the usual operational and market context challenges that is worth mentioning. In Africa, there are few or rarely have I come across, maybe except for South Africa, few institutional players in this in the rent-to-own market. They're not always adequately regulated. They're largely informal. They're not well scaled up. The consumer interest is not always well protected where it's practiced. The length of the period for people to exercise option to purchase are sometimes too short compared to international examples. And at times the products available are largely inflexible. Then specifically in terms of some of the operational challenges, which I've highlighted on the slide, where people are tenants, some of the maintenance charges are high, then the ability for them to scale up in order to buy, to own part of the properties can be quite expensive. Also, it's not unknown to, in terms of some of the experiences we've seen, that actually the mortgage finance, in order for people to exercise their option to own, are not always available. So we're not saying it's a perfect tenure, it's got its challenges, but one of the things we'll be talking about is some of how those issues can be addressed and the preconditions that need to be in place for going forward. So I will now pass on to Derek, unless, I mean, Casey, I'm assuming the questions comes in at the end, so I'll pass on to Derek to then take on the next section.
Okay, can I? Yeah. Hi, everyone. The first thing to say is that when we've been designing rent-to-own schemes, we start with a basic principle that the scheme should work if it didn't have any subsidy, if it was purely a market scheme. And the reason for that is because you need to have a scheme that works within the legislation and regulations that apply in that particular country, and the judicial arrangements, and the way that the banking system operates. So we always start with the principle that it's got to work within the legal and financial framework of that country. And then once you've got a working scheme, then you can look at how could we make it more affordable for lower income households by reducing the costs to meet the income parameters. But that's the second question once you've got an operating scheme. And typically these schemes are based on what you find in a lot of countries in Africa, Asia and South America, is that developers have to sell their homes on installments because the purchasers can't get more affordable mortgage loans or any mortgage loans at all. And the developer maybe sells the home and gets it paid in installments over 5 or 6 years. And these are about extending that principle so that the purchase is actually over a longer period of time. And rather than the developer doing it on an informal arrangement, does it on a contract or a tenancy so that it's suitable for investment by a pension fund or security for a mortgage loan. So if we look at the basics, is you have a developer builds the home, an investor purchases those homes from the developer with a mix of equity that the investor provides and loans and commercial loans which the investor takes out secured on the property or other assets. Typically in a lot of countries this is from the pension and insurance fund industry because these are long-term investments and they can match the returns on that with their liabilities to their pensioners or beneficiaries. This isn't as simple as persuading the pension and insurance funds that they want to invest in these. Very often you have to help them work with their regulator so that these assets are treated in a favourable regulated way on their balance sheet, and that they don't have to give it excessive weighting. So part of getting investors from pension funds is about making sure it works within the regulations in those countries, whether they're a state pension fund or they're a private pension fund. The homes are then let on either a contract basis or a tenancy basis, depending on the legal framework, to the tenants. And these contracts have a purchase option in them. And we'll look in a second about the main types of purchase options. But critical to all this is that the tenants pay a rent as specified in the contract and the tenancy, but have the ability to put additional money aside to buy the property in installments or to have an extra money that they pay on top of the rent to put into a savings scheme so that that provides partly the deposit, partly the security for them to get a loan to purchase the property later. And all rent-to-own schemes work in this way, although there's a whole variety of them. Next slide. And one of the two main ways is buying in installments. This is where the tenant puts down a deposit at the beginning, which is effectively a payment for the option to purchase. And that money is typically held by a trustee, might be a bank, might be a pension company, because this is a long-term contract, and I'm afraid a lot of tenants would not have a lot of confidence in allowing the developer or the investor to hold that deposit, because there's a history all over the world of that money sort of disappearing, or the developer investor selling the properties to someone else or getting a charge. So the cash that's not needed for the rent in all these schemes is held by a trustee in some form or other. The tenant pays the rent lots of different ways. It can be index linked to inflation. It can have steps in it. It can be for a long term or renewable term. There's lots of different ways of doing it. And then on top of the rent, the tenant puts money aside for the installment to fund the deposit, and effectively later on part of the contributions for the purchase installment. And that money goes to the trustee as well. And those monies held by the trustees are normally invested. There's controls over what that investment is. It's usually, again, things like government bonds, things that are not too speculative. Next slide. When the money held by the trustee is sufficient to make an installment purchase, then those monies are transferred to the developer investor. The tenant may also get a loan. It depends on how much they've saved with the trustee, and the tenant can buy an installment. If they buy the installment, say it's 25%, then the rent goes down by 25%. So they're starting to save higher sums in the future, and the next installment rolls around quicker. We'll have a look at some of the issues of doing this a bit later, but obviously you need a regulatory system where it's possible for part ownership of a property to be registered, and if you're going to get loans, that it's sufficient security for a bank to provide mortgages. Now that sounds quite unlikely, and certainly in Africa at the moment it is unlikely, but in Europe and growing and increasingly in Asia and South America, mortgage regulations and pension fund regulations are changing to allow these kind of rent to own with buying in installments to be commonplace. But in Africa now, this would be the more unusual one of rent to own, even though in the rest of the world it's probably the most common and comes under the name of shared equity or flexible tenure. Next slide. The other main form of rent to own is where the tenant rents the property from the developer investor and pays a deposit to have an option to purchase. And that option to purchase will normally say that after 5 years of renting or whatever, they have the option to purchase the property between years 6 and 20, providing they're still renting the property, at a price which is fixed previously. So it may be that it's the original building costs with indexation or a fixed step, but it's a known price that they're saving for. And then they take their additional rent and it's put with the trustee. And also very often the trustee in these cases are a bank, a commercial bank. And the incentive for the bank of holding these increasing deposits is that they will provide a commercial mortgage loan to help the tenant purchase the property when they exercise their option. If they don't exercise the option, then that deposit, which is usually between 5 and 10% of the cost of the property, is forfeited as compensation to the developer investor for effectively renting and providing that option. And so you can see in both these examples, there should be a commercial, the financial model at the beginning is for a commercial return for the developer investor. And that's why it's a market scheme. Can we go on to the next slide? But there are a number of issues, and Olu's referenced these. First of all, you could only do things which are within the legality of the country. And so very often you need help from government or city authorities so that these contracts and tenancies and options and investment are within the legal framework. While it's tenanted, who is the responsibility for repairing the property? What are the terms on which the property is purchased? And very much this is about when the options can be exercised, what the price will be, and if there's an independent valuation of the property for the purchase, how that independent valuation is done. So and it is, we found much better that it's actually on a formula basis, because people have different views of what an independent value is, and it is quite difficult to ascertain in some cases, and it's much better if there's some fixed price which is referenced to at least a semi-reliable index. The terms of forfeit, i.e. what is it when the tenant would forfeit the right to exercise their option? And obviously rent arrears is obviously one of the major ones. Who holds the funds? There's been rent to own has in some countries got quite a poor reputation because people have paid deposits and never found the home, or the money has disappeared or been badly invested, or various other, the property's been sold without them knowing. So you need to have something which allows the tenant to have in security of its option, which is usually being able to register a charge on the property, and a reputable organisation to hold the funds. Contentious item of whether tenants can sublet, and can they sell their right to purchase the property? Could they sell their rights and their tenancy to somebody else? And whether there's an instalment option, whether that can be legally put together and enforceable. And in a lot of countries, that's been quite difficult because the legal system doesn't recognise part ownership of properties. Next slide. We called this making it work, but it really summarises what we've seen before, is that it's got to be financially viable for the investor and for the tenant, that there's a control of risk, not only for example, about how much the rent might go up, but actually the governance and security of the property and their relationship with the landlord. If the tenant walks away, which might not be just because they don't want to do it anymore, they might lose their job, they might have to move for family reasons or whatever, that the investor gets some recompense because they've lost the potential profit on sale, which is in the financial model, and that's usually involving in the deposit. In a lot of countries, the tenants pay by installments currently because they can't get loans, but obviously it works better if tenants are able to get, if there is a source of mortgage loans for tenants, even if it's only combined with the tenant's own savings. And the tenants do have leverage in that because those savings do mount up over time, and for lenders, they could be useful deposits which increase their lending. Land registration obviously is important so that the ownership is set and is on the register. And we talk about the controls, and we mentioned one before about pension funds being able to hold these as assets in their balance sheet. And all those above hopefully give confidence for both parties to take part in this kind of a deal. And it's worth always saying that it should be easy to understand, i.e. that both the tenant and the landlord and investor can explain the basic principles of the deal and why it's good for them and what the risks are without whatever their financial background, so that people are going into it what we call with their eyes open. They know what they're getting into. Next slide. So preconditions to success. Long-term finance, first of all, for the investor, and also potentially for the tenant, because then the tenant can buy much earlier if they can mix their own savings with mortgage loans. Effective legal system to enforce the tenancy contract, whether it's the option to purchase or the tenant to pay their rent. Straightforward responsibility for who is responsible for the management and maintenance. Is it the landlord? Is it the tenant? And what happens if one or other don't satisfy their obligations? None of this works unless there's supply of suitable housing. So if you're setting up this, you need to make sure that there's at least some developers and some schemes that can fit into this scheme and are going to be offered on the scheme. And a regulatory system to monitor providers. This can stretch from making sure that the buildings have been suitably built, that the ownership has been checked, that the organisation providing the investment and entering into the contract is legal and at least has suitable governance. And in some countries, to manage these schemes, there's been a regulatory regime either from one of the Ministry of Housing, city authorities, central banks, but there is a regulatory body who's responsible, and very often they're also the body that's encouraging lenders to provide mortgages for these schemes. Next slide. both schemes are capable of being subsidised in order to make them work for lower income households than would if they were pure market scheme. Normally, it's a land contribution. Basically, government or an NGO provides the land that the houses are built on to reduce the cost of the home. Sometimes it's land plus a cash contribution towards the infrastructure costs, like electricity, sewage, so making the site ready to build on. Now, this only can work if the tenants, these lower income households, have enough income to make the savings that will allow them to purchase. And if the tenants are going to need loans, that there's a source of loans that are suitable for those tenants. And very often, these are tenants who don't necessarily have formal sources of income, which makes it difficult for the banks to lend. But sometimes also they're public servants or in employment which has a SACCO, which already has a scheme for providing affordable loans. But there's no point in doing it unless the tenants are going to be able to purchase their homes. Otherwise, you might just do a straightforward rental scheme. The scheme has flexibility, and one of the things subsidy can give you is the flexibility to allow tenants to walk away if they can't afford it or have to move for work or for other reasons. And again, it's got to be easy to understand so that everyone knows their responsibilities. However, you provide subsidy, you don't want someone taking on the scheme and then immediately selling it to a higher income household and taking the benefit. So there has to be a system that captures any value that comes out of the subsidy and reinvests it back into the housing. Again, repair, these are households who maybe would find the cost of repairs expensive. So the arrangement needs to make sure that not only is there a repair responsibility, that it's understood where the money will be coming from to pay for those repairs. And obviously it needs someone's got to manage it as well. So whoever the investor is needs to show that they've got management skills. And as always, it has to work within the legal framework of the country. And if not, it needs that amendment before you can actually start doing schemes. And very often one has to say that you sort of design the perfect scheme, but then you have to think, actually, that's not going to work here because the legal system specifies it in a different way. And then you have to take your perfect scheme and make it work within the existing legal framework, because it will take too long to make the changes if you can make the changes. And very often that's all about, as well as designing it to fit the willingness of the banks to provide the loans, rather than actually saying, well, these are the loans that you need. I think that's the end of my slides. So,
Derek, can I ask you a question? And maybe if you can go back to that last slide, because there's a number of comments on the chat around affordability. And the point that one person is making is, and I'm sure colleagues, you can all look and see the actual wording and who said what. But the one comment that someone is making is that in a rent-to-own scheme, the monthly repayment would likely be larger than what a rental would be. And yet we want it to be affordable. So that's when I guess this question of subsidization comes in. And then someone else is making a question, asking a question, well, when low-income earners become owners of properties, oftentimes their ability to maintain that property is compromised. They don't have the income to do that. how do you balance all of that up? And around that maintenance question, where is the boundary of liability and responsibility, and how do you manage that? It seems like we're stretching it from all sides.
Yeah,
maybe you can comment on that.
There are lots of different schemes, but if I can take the last one first, because the experience of schemes elsewhere has been that while the household are tenants, then they have very limited repair obligations. So it's not a good example, but they're responsible for changing the light bulbs, but the landlord is responsible for anything to do with the fabric of the building. But as soon as they become owners or part owners, that responsibility switches to them. And when you're doing the financial model that says, can they afford it, you actually have to include the cost of doing those, of an amount for repairs. And that rather links into this question about, obviously, if you have a subsidy, you can reduce the costs for households to go into this scheme, and therefore it may well be cheaper than commercial renting. But if you're looking at it as a purely market scheme, yes, these households are initially they're spending more on than what would be the rent. However, the difference here is that when you do market rent in most of the big urban centres, first of all, landlords tend to ask for a large deposit, and in a lot of countries is sometimes 1 year or 2 years rental as a deposit. Secondly, when we looked at in a couple of countries recently, what the rentals that people were paying, as opposed to a percentage of the what they would pay if they could get a mortgage loan, those rentals were actually more than they would have paid for a mortgage loan. But the problem was the difficulty they had was that there was no provision, there was nowhere where they could get that mortgage loan. And so ownership wasn't a choice to them.
So you mean here that in fact what it is that this is solving the access problem, not necessarily the affordability problem?
Yeah, it's not, this is not cheap. This isn't going to be cheap without subsidy. This is never going to be cheaper than someone renting. But what we looked at was that the rent that people were paying could, for the same amount, they could do a scheme. And partly that's because the landlord or the investor gets part of the gain in the increasing future value of the property. So the rent is stepped. So we've looked at two schemes, well, there's several schemes in Nigeria and Rwanda, where the tenants are on a stepped rent. So the rent at the beginning is lower than they would pay if they were doing a purely commercial rental scheme and less deposit, but the rent goes up in steps each year, which gives the investor a return. So effectively, for the same cost, they are buying a home, which they will own, and eventually the rent payments will stop. But unless you can, without subsidy, this is a different way of taking a home that could be rented into a purchase. arrangement, and you can then do a bit of financial structuring so that it's cheaper at the beginning and a bit more expensive later on to make it fit whose income. And it's worth saying that most of these schemes tend to be for people who prospectively can see that their income will increase in the future. One of the schemes I'm thinking of was for junior doctors or trainee doctors as a way of effectively getting on the housing ladder, teachers, nurses and so on. It's a scheme that allows people who really probably are on a lower middle income to purchase a home which they couldn't afford to do and not pay out in rent in higher sums. So this is not social housing. This is a restructuring of home purchase in order to make it more available, and available in countries where it is difficult to get commercial loans, or loans are very expensive. And it's SACCOs, who already provide mortgages. It's a sort of a restructuring of how that works.
I see that in sessions 2 and 3, you'll be looking at different models of rent to own, and then the financing and legalities of rent to own. So perhaps you'll get a bit more into the math then, because I think this is a critical question and something that would be of great interest to colleagues, 75 of whom are with us at the moment. Olu, you've been monitoring some of the questions on the chat. Do you have any comments or responses that you want to make verbally now? I see that you've responded to a bunch of people, and we all know where to find you, but...
Yeah. No, I think the theme of the questions are things like whether the disadvantages or the challenges of implementing rent to own. And as I said in some of my responses, my experience is that what people call rent to own at times in Africa, and I'm not speaking, I've not seen all rent to own projects, are what we would call possibly hire purchase schemes. They're mainly instrumental payment, and it's partly because of the challenges of absence of long-term finance. These are mainly developer-initiated programs in order to sell the properties. And some of the structures would normally want to put in place into rent to own, like making sure that the money being paid is kept away in a trust in a bank, or in some cases, the length of time is exceeds the current 3 to 5 years. Normally, you probably, if you go a proper rent to own scheme, you're talking about maybe minimum of 10 years, because really the whole idea is to match people's income progression with the ability to purchase going forward, and then giving them an option at the end of the period to either purchase if there's mortgage finance, or an arrangement where that savings could then contribute towards outright purchase. And then you need to have a valuation system and all the sort of arrangement. And as Derek says, you also, as people buy or seek to put aside a significant amount, the sort of responsibilities changes. So that's some of the questions that was coming, and I think I was responding to that. And there was a question about why does this seem being perceived as predatory, and my sense is probably because it's not well regulated in some cases, and it's not institutionalized. There's no sufficient big institution. And what we're trying to do with this series and debate is actually calling, I'm sure our pension institution friends that are within Africa, because it's a successful institution in Africa. And, you know, Casey, we did some research for you in the past about looking at the role investors or long-term investors could play in affordable housing. I think this actually potentially a product, if well structured, could be an opportunity for pension institutions to come into it, because it's very good product. That one, it's got an underlying asset. Secondly, it helps them to match their liabilities with, and then thirdly, they can also have a rental stream that they could securitize. So that's some of the themes coming in terms of some of the questions I've answered. But I'm trying to answer as many as possible. But as we've offered before, please send the emails. We'll try and send the response to you.
Thanks for that. And also, I think that there's going to be lots of interest then in also the fourth session, which is where you talk about case studies in Africa, where we're seeing it. You know, in Kenya, there's lots of interest around tenant purchase schemes. And it's specifically, in my understanding, it's about the access question. It's about how do you structure access to get a product because the finance isn't there. And it, as Derek said, that it's still there still will be the affordability challenge, but we'll have one part of the problem solved. It would be nice to see maybe in the next session or the one thereafter, like a table that puts them all together and shows how to think about them, because I'm still not entirely clear about how all the models work and what you gain with some and lose with others and how to fit it to a context. So I think that could be quite interesting, and we could even then share that. We have 2 minutes left. Do you have a punchline? There are 2 people who've raised their hands. One, well, oh, they're gone. And one person now has additionally raised their hand. And I don't know, we didn't discuss if we were going to allow that. I would rather suggest, please put your comments into the chat. It's probably the easiest way to manage it in our 2 minutes. But do you have a final word, Derek or Olu, that you'd like to make?
I think go on, Derek, you go on.
Remember on these is that this is not something for people who cannot afford housing. If you can't afford to rent a home, it's going to be very difficult for that household to be able to afford a rent to own. This is schemes about households who can afford to rent, using that affordability to better their interest in the quality of home and to get ownership. But this is not a way, unless someone's willing to provide subsidy for people who can't afford to rent a decent home to get a decent home.
That's such an important line, what you said.
That's all about actually building more homes to rent and having a structure for a decent rental market. But this is about giving households who have ownership aspirations and can afford to rent in the existing market, perhaps to get a better home, but also to be able to purchase, particularly in countries where mortgage loans are difficult to come by.
So there was one question in the chat, which I'd like you to answer at the next session or possibly the one after, which was, how do you underwrite? If it is an access question and the banks haven't figured out how to lend something to this person, then how do you figure that out? How do you underwrite in that context? If it's an access question, I think we don't have time for that whole answer. But
there's a one-word answer. This is how you involve the investor in the home in the scheme. That it's not just the bank providing a loan. It's the investor who gets benefit out of it, being involved in the process in the financial structure.
So we'll need to hear more about that in the next couple sessions, but that's great. Olu, anything from you? We're over by a minute, but I think people will forgive us.
I mean, from my end, it's just to assure people, I know that this is the first session, so there's a lot of questions. We're going to capture them and make sure that we either answer directly or make sure we feed it into the next iteratives, the next sessions. But in terms of your point about how the transaction is structured, we do have in the next couple of sessions slides that shows the link between different parties, because I think that's very important. And then the next session is also focusing on this issue about management and maintenance, because again, like we said, in terms of true rent to own, you need institutions that are managing the assets. And at the moment, in a lot of places in Africa, that bit is missing because most of it is developer-led, other than truly institutional setup.
Yeah.
That's my big worry, actually, that one.
Okay.
It's worth saying now we've just tried to do what we normally do in 2 or 3 days with local authorities or governments or whoever. So it has been very truncated.
No, we get that. We get that. And I think you're making us all hungry for more. So if I could just say to everyone that the next session it's on my birthday on the 17th of August. And there we'll be analyzing different models of rent to own. And then after that, on the 8th of September, is the financing and legalities of rent to own. And then on the 21st of September, rent to own case studies from Africa. And we are really open to conversation. So please send us any questions or comments or arguments. I will forward those directly on to Olu or Derek, or you can write to them directly as well. Let us know. And what I didn't say at the beginning, which I'd like to say now, is please visit auhf.co.za and take a look at it and see if you'd like to join as a member of the AUHF. It would make us stronger, and hopefully it would make you stronger too. So thank you very much. Thank you, Olu, and thank you, Derek. Thank you also, Jennifer, who's in the background there from Altair. Thanks so much to Tandiwe.